Hi, I'm Dongshang. Welcome to Digging into China, where we explore China in depth to review unique perspectives. In today's program, we'll take a moment to review the recent activities of the People's Bank of China, the nation's central bank. Lately, it seems the central bank has been operating quietly while the Ministry of Finance has been in the spotlight, frequently holding press conferences and announcing favorable policies. However, make no mistake, the central bank has been far from idle. They've been diligently working behind the scenes on several significant initiatives. So, what has the central bank been doing? First, they've resumed the trading in treasury bonds. Second, they've arranged for commercial and policy banks to extend 1 trillion yuan in loans to local governments. Third, they've opted not to follow the US Federal Reserve's interest rate cuts, aiming to manage stock market liquidity and prevent a crisis like the one in 2015. Beyond these, there is a fourth action: strengthening the yuan's exchange rate. The central bank has successfully raised the yuan's value to around 7.1. Have you considered how these actions might be interconnected? In particular, how will the central bank manage the 1 trillion yuan in loans to local governments? Could this lead to unintended consequences, and what insights might it offer for our investment decisions? In this video, we'll explore the policy signals behind these moves. Monetary policy typically falls into two categories: expansionary or contractionary. In the years following the pandemic, most countries have adopted contractionary policies, but China has leaned toward expansion. However, this expansion isn't absolute. It's a blend of targeted easing and tightening measures. Consider the current performances of the yuan's exchange rate and the stock market. It's difficult to describe this as fully expansionary. The central bank is leaning more toward restraint. How do they strengthen the yuan? By selling dollars and buying yuan. Notably, the central bank's balance sheet has been contracting this year. Meanwhile, on the fiscal side, China's economic slowdown means funds are needed across the board, requiring the central bank to ease monetary policy to provide liquidity. Thus, the central bank's current approach is one of selective easing, balancing multiple objectives. For instance, in early September, during a meeting with the Ministry of Finance, the central bank signaled it might resume treasury bond trading. This tool can serve a dual purpose. Buying bonds signals easing, while selling them indicates tightening. The central bank can also adjust the yield curve structurally, as we've seen in recent years. They've purchased the short-term bonds to lower their yields while selling long-term bonds to raise theirs, resulting in a steeper yield curve. For the central bank, treasury bond trading isn't primarily about easing or tightening. It's about regulating interest rates. By influencing treasury bonds rates, they guide market interest rates, a far more effective tool than the current long prime rate or LPR. The central bank has long sought to emulate the US Federal Reserve, using open market operations to adjust treasury bond rates as a benchmark for marketing borrowing costs. The LPR, by contrast, is less efficient, quoted monthly through banks to guide private borrowing costs, which can lead to mispricing or delays. Treasury bond trading, however, occurs daily, with market rates reflecting real-time responses, avoiding lag or errors. To illustrate, the LPR is akin to a heavily administrative guideline price, reminiscent of fixed prices in a planned economy. The authorities set a figure, but the actual market price often diverges. For example, if the guideline price for rice is 1 yuan per kilogram, the market price might already be 2 yuan. As this gap widens, people naturally trust market signals like treasury bond rates or interbank lending rates over the LPR. Consequently, the LPR's relevance is waning, and the central bank is increasingly focused on directly influencing market rates. China's current challenge isn't a shortage of funds, but insufficient demand for credit. The central bank cannot address systemic issues such as the persistent bias against the private enterprises in the financial system, while state-owned enterprises and the local governments enjoy preferential access to financing. These issues lie beyond the monetary policy's reach. In this context, the central bank's role is to reduce borrowing costs technically, and adjusting treasury bond rates remains one of the few effective tools to stabilize credit demand and prevent further economic decline. Additionally, the Ministry of Finance has directed commercial and policy banks to lend 1 trillion yuan to local governments to settle debt owed to private companies. This effectively pressures the central bank. These loans are essentially low-quality assets, low interest, high risk, long-term, and often unsecured. For banks, such lending is not only unprofitable but could lead to significant losses. This raises the specter of systemic financial risks, forcing the central bank to step in as a backstop. One approach is providing targeted liquidity to ensure banks have funds to lend while also assisting with managing bad debts. How is this managed? Through tools like relending, matching loans one-on-one. For every yuan a bank lends to local governments, the central bank provides an equivalent amount of funds, allowing banks to lend without using their own capital, effectively transferring bad debt risk to the central bank. Should bad debts accumulate, the central bank either absorbs the losses or prints money to offset them. However, such measures can only be used sparingly. The central bank's asset composition is transparent, and filling its balance sheet with low-quality assets would severely degrade its asset quality, triggering a cascade of consequences. First, the central bank's ability to inject liquidity could be compromised. Issuing currency relies on the quality of its assets as collateral. If those assets are predominantly low quality, the central bank credibility weakens, undermining confidence in the yuan and driving down its exchange rate. Second, monetary policy could lose effectiveness. With a balance sheet burdened by fiscal liabilities, the central bank's policy options are constrained. Raising interest rates or shrinking the balance sheet becomes risky, as higher rates would further devalue low-quality assets, harming the central bank first. This creates a fiscally dominated central bank entirely subordinate to fiscal policy. Third, in desperation, the central bank might print money to cover deficits, potentially leading to severe inflation. Over the past 2 years, the central bank's autonomy has steadily eroded, with its balance sheet increasingly filled with fiscal liabilities. Last September, a new policy allowed the non-bank institutions to use stocks as collateral to borrow directly from the central bank, marking a shift from holding only high-quality assets like foreign exchange or treasury bonds to including riskier ones like stocks. I believe the September 24th policy last year was a pivotal moment, signaling that the central bank began prioritizing economic stability over its own asset quality, subordinating monetary policy to fiscal needs. This year, the Ministry of Finance has intensified this trend, pushing another 1 trillion yuan in low-quality government debt onto the central bank's balance sheet. However, consider this. Tsinghua University economic professor Li Daokui estimated that the local governments owe private companies at least 10 trillion yuan. This 1 trillion yuan is merely the beginning. Another 9 trillion yuan awaits. And even that may not suffice, given the scale of local government debt, which runs into the hundreds of trillions. The more you address it, the larger the problem grows, and it's effectively unpayable. Given these signals, can anyone doubt the risk of severe inflation in China's future? The central bank has lost much of its decision-making independence, increasingly exploited by fiscal demand. While the Ministry of Finance burdens the central bank's balance sheet with low-quality assets, the central bank must expand its highest quality foreign exchange reserves to prop up the yuan's exchange rate. Doesn't this accelerate the path to financial strain for the central bank? China is often labeled a currency manipulator, and amid the ongoing trade war with the U.S., U.S. Treasury Secretary Bessent and the Chinese Vice Premier He Lifeng held trade talks in Madrid, Spain, in mid-September. Leading up to this, the yuan's exchange rate rose steadily to around 7.1. This appreciation aligns with the objectives of the current Trump administration, which seeks to reduce the U.S. trade deficit. For China, however, a stronger yuan is not necessarily beneficial now. Without exchange rate advantage, export companies must rely on increased fiscal subsidies to maintain orders or risk supply chains relocating abroad. More subsidies increase the fiscal deficit. Historically, when exports faced challenges, China's government typically chosen yuan depreciation over fiscal subsidies. This time, they've opted for appreciation, relying on fiscal support to sustain export orders. Does this suggest external pressure or a trade war compromise? Could China be using yuan appreciation to reduce the U.S. trade deficit in exchange for concessions such as access to U.S. semiconductors? I believe only the tech industry's need for chips could prompt Xi Jinping to temporarily prioritize this over export-driven dollar earnings. Regardless, the central bank's asset quality will continue to deteriorate, as foreign exchange reserves must be depleted to sustain the yuan's value until depreciation is permitted. Recently, Reuters reported that central bank insiders indicated China would not closely follow U.S. rate cuts to mitigate stock market risks. With the central bank's asset quality declining, doesn't it seem unlikely they'd cut rates? Lowering rates would reduce market interest rates, devaluing the low-quality assets in their portfolio. Moreover, maintaining the yuan's exchange rate requires continuously expanding dollar reserves. Is there a way to preserve the central bank's asset quality? Indeed, there is. Consider what the central bank has been doing: purchasing gold monthly. Gold prices have surged this year, with major investment banks predicting a rise to at least $3,800 by year-end. From this perspective, would the central bank allow gold prices to plummet? They hold over 2,300 tons of gold reserves and continue to buy more each month. A sharp drop in gold prices would further impair their asset quality, potentially hastening severe inflation. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. Also, don't miss out on YouTube's new hype feature. Click the hype button to boost this video on the leaderboard and help spread the word. You get 3 free hypes per week, so use them to support my channel and make a big impact. I'll be back with more content soon. Until then, be well.